Brazen.
There was a moment in the pandemic when I noticed tons of the same kind of brown box piling up around my neighborhood. Delivery workers would drop them off in front of the houses on my street. These packages would pile up in the entrance of my apartment building for my neighbors. There'd always been plenty of Amazon packages filled with whatever supplies folks were ordering during lockdown. But these weren't Amazon packages. These were packages from a place called Chewy.com. Chewy is today one of the most popular U.S. retailers for all things pets. And pets are a big business. Americans spent more than $100 billion on their furry friends in 2020. But just a few years earlier, the e-commerce startup was a controversial part of one of the most successful private equity turnarounds in history. One that our guest this week says came very close to not working out at all.
A lot of times people will say, write about my successful deal, but then they won't really tell you how close it came to not being successful, which is what happened here. It was really a close call.
This is The Closer. I'm Amy Keene. Welcome back to The Closer. Last episode, we covered the story of a private equity deal gone bad. That was Toys R Us. This week, we have what I've been thinking of as a private equity redemption story, a story of what happens when a struggling retailer gets the right investor to turn things around. Private equity tends to get a bad rap. We think of these firms acquiring companies and then stripping them both of costs, sure, and what customers loved about the brand. My guest this episode, Miriam Gottfried, says that's a bit of an outdated idea.
I've watched the industry mature a lot, I think, over the past 5.5 years. It's become more open because it has to be, because it's bigger and more firms are public. And it's become responsible for a much broader swath of the U.S. economy and the global economy, for that matter.
Miriam covers private equity for the Wall Street Journal, and she's the perfect person to take us inside private investment in the pet business. Not only because she's been covering this part of finance for many years, but also because she's proudly part of the more than 90 million American households that own a pet.
His name's Fauci.
Fauci?
Yeah, he's named after Dr. Fauci.
Here's Fauci letting out a big yawn.
He's a post-pandemic dog. Back in 2020, my husband and I, we kind of took comfort from Dr. Fauci's words. And we were like, we should get a dog and name it Fauci because that's just so cute. Fauci's this small, tough guy from Brooklyn. And that's sort of what our dog is too.
We'll return to Fauci the dog a bit later, but back to our story, which begins in 2014 with the popular pet store chain called PetSmart. It was in a bit of trouble. Growth was slow. The story at PetSmart was similar to that at a lot of specialty stores. Shoppers were ditching the chain in exchange for more convenient and often better-priced options at big box stores like Walmart and Target. But for private equity investors, the PetSmart business had a lot going for it.
It had steady cash flows, so you can put debt on it. You could cut costs from within the business probably and, jumpstart growth. You could boost the number of services at the business, like grooming and doggy daycare and that kind of thing, and kind of bring more foot traffic into the stores.
It was the kind of bet several PE firms were ready to make, but one firm won out, BC Partners.
It's the biggest buyout of 2014, PetSmart getting taken private by British PE firm BC Partners in a deal worth $8.7 billion, or about $83 a share.
Not only is it the biggest buyout this year, it's one of the only ones.
And its man at the top, Raymond Svider.
So Raymond Svider is the chairman of BC Partners, and he is a Frenchman. Like many private equity executives, he's very smooth, very well educated, refined, and just kind of a gentleman.
Ultimately, on every investment that I lead, I'm the one who's responsible. So I can't turn around to somebody else and say, how did you, make that mistake? Ultimately, it's my mistake. That's the success of any firm.
But he does have pets, so he knew about PetSmart. He has 2 cats. After the financial crisis, the size of buyouts plummeted. People were really afraid to do big deals again. Adding to that it was a retailer at a time when Amazon was becoming much more of a threat, made it kind of risky and scary by the time the trouble started to appear.
In BC's first year owning PetSmart, business was good. The firm managed to improve operations enough to pay itself a dividend. But by 2016, sales started to slide. At the time, Amazon was the one usually blamed for any retail woes.
But it turned out it wasn't Amazon. It was a new retailer called Chewy.
So to you, Chewy.com is an easy way to shop. And to your pets, it's a dream come true.
And Chewy was a pet-focused retailer that had a lot of expertise in pets and was basically trying to replicate the warm customer service environment of your local neighborhood pet store, but online.
Tired of lugging around big bags of pet food and litter? Get it delivered. Chewy.com delivers everything your pets need right to your door. They ship all your favorite brands.
And that was something that Amazon couldn't do, right? Amazon's big and it doesn't have customer service in that way. So Chewy actually had figured out a way to compete against Amazon. And as a result, Chewy was the factor that was eating into PetSmart's sales, the growth of Chewy.
Chewy was founded by a young Canadian entrepreneur named Ryan Cohen. You probably know his name from another big story.
Is the stock that everybody's talking about right now? There's only one stock they're talking about. It's GameStop. And earlier this hour, I reported...
He became the face of the meme stock phenomenon that took off during the pandemic. But Chewy was the first real business he launched back in 2011.
Yeah, I mean, imagine a young man with no formal education trying to start a business that required a lot of upfront capital. He didn't get very far at first.
It took me over 2 years to finance the business. Over 100 investors passed, lots of no's.
The way he described it was he went cold calling on Sand Hill Road, which is the main street of Silicon Valley where all the venture capital firms are based. And he was told no over and over and over and over again until finally somebody said yes. And that was this firm called Volition Capital, which looked at the recurring revenue, the repeat business that Chewy was getting, and said, this is something different. This is different than a regular e-commerce company. And that was what convinced them to invest. And they provided a $15 million investment, which is what allowed the business to continue.
But we kept on scaling the business. It was just heads down, blocking, tackling, focusing on amazing execution. And I think everyone underestimated how well we would execute and how big of a business we could build.
He founded the company at age 25 with a friend. He had never had a real job before. He's really a unique entrepreneur, but he knew he wanted to start a business. And he got the idea from, going into his local neighborhood pet store with his teacup poodle and having this really nice interaction with the owners of the store and saying, how can I bring this level of expertise to e-commerce? How can I make my business stand out from the behemoth, which is Amazon?
Here's how he did it. He brought the vibe of the local pet store to an online shop, and he made customer service a priority.
This is an artist painting a portrait of a cat. She wasn't hired by this cat's owner, but by Chewy, the online pet supply store.
They will send you flowers. If they will send you pet portraits, they will give you 24/7, 365 customer service. So if it's 1 a.m. in the morning and you need advice on how to feed your dog a certain type of product, you can call them and they will talk to you.
So they would allow their customer service agents to stay on the phone for as long as needed. I mean, people would be on the phone with customers for 2 hours sometimes.
Oh my God.
People would just call to chat and they would talk about their dogs and but by the end of that conversation, they would think, this is a great company.
These were people who saw their pets as part of the family, and Chewy recognized that special bond. So the pet owners were hooked.
Chewy would win over a customer for life, basically. They would set up an auto shipment and forget about it, which is ideal. And anytime you can have recurring revenue in any business, investors will give you a higher valuation.
A startup e-commerce site with recurring revenue, the kind of business model investors and retailers dreamed of. But to get those lifelong customers, Chewy had to spend money.
It meant that as Chewy was growing, it was spending more and more money because it was acquiring more and more customers. So it looked less profitable because the upfront costs of acquiring customers were so steep.
So Chewy's a growing, promising business, but it's not yet a profitable one. Meanwhile, back at PetSmart, Raymond Svider has a problem of his own. He's trying to think of how to jumpstart growth at the pet store he now owns through BC Partners. They'd managed to take that dividend in the first year.
But then things took a turn for the worse. And, the timing was bad, and this was like a big investment for them. So that's why Raymond really stepped in and became so closely involved in the deal.
And he makes what the market thinks is an unusual move.
And he basically saw it as what he called a make or buy decision, meaning we see that this upstart Chewy is eating into our sales. So we can either try to replicate that by making our own Chewy, or we can buy Chewy. And he decided that it was too late to replicate it. So he decided to buy Chewy.
It was a tough bid to make. Chewy founder Ryan Cohen and his early backers weren't ready to fully hand over his company to new owners.
They realized that it was a hot commodity. It was growing quickly, and they wanted a big price.
Svider first approached Cohen with an email. By this point, Cohen was considering an IPO for Chewy, plans he'd eventually toss out. And the two men, Svider and Cohen, started to build a relationship with one another.
I think Ryan was kind of skeptical of private equity, but I think what he realized was that Raymond understood what he was trying to do. Raymond knew that you couldn't just take Chewy and merge it into PetSmart, which is what you would normally do when you buy a company. It needed to be treated as a separate brand, and that was where its value lay. So that was really important to Ryan.
While Svider's trying to make his case to Cohen, rival Petco starts sniffing around. Petco wants to make an offer in part in company stock, but Cohen wants cash. This is where Svider delivers.
And so Raymond took a leap of faith and basically borrowed more money in order to be able to pay cash for this asset.
Svider adds an additional $2 billion of debt to PetSmart's books. This is on top of the $6 billion of debt that came with the buyout.
And over time, they were able to negotiate a $3.35 billion deal, which at the time was a record for an e-commerce company.
PetSmart is buying a big online rival called Chewy.com. It's a fast-growing online pet supply retailer based in Florida. Well, CNET is reporting that PetSmart won't likely change the name of the site, and it'll let the company continue to operate as an independent subsidiary.
Can you just describe the reaction on the outside?
Yeah, I mean, everyone, including me, we were like, what are you doing? This is so risky. How is this going to work?
Pretty quickly, PetSmart debt holders got nervous.
Because already they could see sales declining. There was a lot of debt on the company. They didn't want to be putting their investment in the debt of the company at risk.
And here was Raymond Svider, adding an unprofitable business to the mix, one he'd paid top dollar for.
We'd just kind of all seen what had played out with other retailers, including e-commerce companies that tried to compete against Amazon, and it seemed futile. And that was what really frustrated Raymond. Nobody could really see what his vision was at that point in time. But he was confident in what was happening. He saw what was happening in Chewy's numbers. He understood that once Chewy got beyond this growth phase, it could easily become profitable because the company was just using its resources to acquire customers. And there's another company that did that for a long time and then became the most dominant retailer in America, and that's Amazon.
Yeah.
So Raymond could see that it was working.
Was this around the time that you started writing about what was going on at Chewy PetSmart and kind of starting to ask some questions about exactly how this investment was unfolding?
Yes, I think that was about around the time that I was meeting with Raymond for maybe the first or second time. He said, "You've got it all wrong." And I said, "Okay, well, tell me what is right. Tell me what is happening." And he said, I'll tell you what's really happening, but I'm not ready yet.
We're going to take a quick break. We're back with Miriam Gottfried. After she wrote a story about trouble at PetSmart, BC Partners chairman and PetSmart owner Raymond Spider told her she had it all wrong.
And I said, okay, well, tell me what is right. Tell me what is happening.
Eventually, he did. Miriam went to see him in person.
I came into the BC Partners office in Midtown, and Raymond was like, maybe a little more annoyed with me than most people are who meet me. Because at first, I was like part of this chorus of naysayers that was really frustrating to him. And he needed kind of help telling the story. And I think I was like, well, why don't you just tell the story then? But he wanted it to play out more.
A few things had happened since the Chewy acquisition that had a lot of people questioning Spider's strategy. First, sales at PetSmart stores continued to decline, so Spider stepped in as CEO. Then, in March of 2018, another specialty retailer, Toys R Us, announced it would be closing all of its stores that year. This was just a few months after the toy retailer filed for bankruptcy, and investors holding PetSmart debt were afraid they were heading down the same path.
From the outside, it seemed like another retailer heading in the wrong direction. We had Toys R Us file for bankruptcy and actually be forced to liquidate by its creditors. And that was sort of a poster child of an Amazon victim and also of a private equity retail deal gone awry. Its death may have been inevitable anyway, but it had been hastened by the large amount of debt that it had because of this buyout.
At the same time, PetSmart was trying to shore up as much of its investment in Chewy as possible. And in doing so, it made another move that really frustrated the investors in PetSmart's debt.
So as retailers started to face more pressure and felt the weight of their debt even more as their sales were declining, a lot of them were looking at what is the most valuable component of my business? How can I, the private equity firm that owns this retailer, take that and separate it from the part that I think is kind of a sinking ship over here?
This is what BC Partners did with PetSmart's investment in Chewy.com. It restructured its ownership in the site, putting a significant chunk of shares out of reach of bondholders.
And the creditors didn't like it because they said, look, we're on the hook for this debt, and you're taking away what could potentially be our only method of getting paid back. And in PetSmart's case, they saw Chewy as that. And they wanted to keep it away from the rest of their bondholders.
And then came the lawsuits. The creditors were mad.
And they were trying to stop it. That prompted further negativity around the deal.
The deal being the acquisition of Chewy.
So in a way, it was delaying Raymond's desired outcome, which was to show everyone that he had actually made a good choice here and that this was going to be a good deal.
PetSmart and its creditors eventually settled their dispute. They agreed that if Chewy went public, any proceeds from that listing would be used to pay off PetSmart debt. And not much later, in June 2019, Chewy made its public market debut.
And it was a huge success as an IPO.
It's a big day for the e-commerce pet supply company Chewy as it's set to IPO this morning. Let's head to the New York Stock Exchange.
As well. Shares are way up on the first day of trading. I mean, way up.
Ryan, congratulations.
Thank you. Thank you. I'm glad to be here.
I would imagine you have a lot of feelings about seeing this company that you built starting in 2011 go public today.
It's a very, very emotional day. It was far from an overnight success. And, see it today is just incredible. So I'm very proud.
It was an emotional day for Cohen. He was the guy who built the company and sold it to BC Partners. But he'd left Chewy with no shares in the company in 2018. He told Miriam that the night before the listing, he was outside the New York Stock Exchange, just crying.
So, I think if you asked him now, he would maybe express a little bit of regret for not having retained a stake in Chewy. At the time, he didn't really know, though. It was like, this is cash. I'm getting it right now. I don't know where this business is going. This is my first company that's taken off in this way. And he became a billionaire. So you can't really say he made the wrong choice either. On the other hand, he was able to take his wealth and invest in a lot of other things. And he's become, quite rich for being an activist investor and also a long-term investor in a variety of companies.
For Spider, on the other hand, this was his moment of vindication. The market was all in on the bet he'd made years earlier.
Yeah, well, I mean, remember that this, at $3.35 billion, it was considered to be a really high price tag for a deal for an e-commerce company. And by the time I wrote about Chewy, which was not long after its IPO, it was worth $11 billion. So think, already with that pop on paper, everyone could see, oh, this investment's going to work out.
So when does Raymond call you back and start to share with you the story from his perspective?
Yeah, I think it was not long after that. He said, okay, now I'm ready to talk about this. And we went through every twist and turn of the deal and how he felt at each point in time. And I got a sense of his frustration, of the leap of faith he was taking when he, decided to have PetSmart pull the trigger and buy Chewy. He said, I'm going to realize as much value as possible. And he was able to pay down debt for the creditors. And then at the same time, they were able to rejuvenate sales at PetSmart. Once they owned this thing that was eating away at their business, they could kind of be benefiting that while at the same time trying to fix what was hurting at PetSmart, at the traditional business.
Miriam had this sit down with Raymond Spider in 2019. By this point, Chewy shares had surged so high the e-commerce site was valued at $11 billion, and sales issues at PetSmart were improving. BC Partners' takeover was already shaping up to be one of the most successful private equity turnarounds in history. Then, the pandemic happened. Millions of people isolated at home became pet owners for the first time. Those brown boxes started piling up around my neighborhood, and Miriam started thinking about getting a dog herself. All of these new pets led to new Chewy customers, and the share price skyrocketed. The company's market capitalization was as high as nearly $50 billion at its peak.
Chewy is down a lot from its pandemic peak, but it's still trading at above where I wrote about it and where they took it public. Mm-hmm. So it's one that's managed to stand the test of time.
And by all indications, the demand for pet food and toys isn't going away anytime soon. Spending on pets in the U.S. topped $136 billion last year. For a lot of people, there's no limit to what they'll buy for these furry members of the family.
We love them. We've gone from an agrarian society where they assisted us with our jobs to, a pretty urban setting in a lot of cases, or suburban setting where they're just our little friends who sit with us on the couch. They don't have any other function besides that.
Yeah, they're part of the family.
They're part of the family.
So what happens to the PetSmart part of the business now?
That's a great question. They still own it. It's doing fine, but it's now how do you exit that? And if you're a private equity firm, you can't own something forever. The way that it works is your investors expect you to sell and return money to them. For BC Partners, they've been able to return money from selling shares of Chewy. They still own large chunk, but they've sold down their stake to some degree. So that maybe buys them time when it comes to returning capital to their investors for this deal. However, they still will have to exit the original PetSmart business at some point, and how they're going to do that, I'm not sure.
So in the end, Miriam, Raymond Spider was right. He said, trust me, I have a plan, and I'll tell you about it when I'm ready. Is there a lesson you hear in this story?
It's about taking a risk that is not apparent to the market, and about the value of kind of trusting your own instincts as an investor and having that pay off. I think that, if Raymond had just followed the conventional wisdom and not gone after Chewy, he might be stuck with another Toys R Us situation on his hands. His ability to stick to his convictions despite a lot of naysayers was, for me, the overriding lesson. He had confidence in what he was doing, and that was enough. And, that's pretty admirable. There's a lot of groupthink that happens in the markets these days, which we've witnessed in a lot of different recent episodes. And if you can be somebody who, has the courage of your convictions, you can make an outsized amount of money. You can win. And that's kind of a cool thing to witness.
And that's the end of our show. On Brazen Plus this week, producer Ben Walsh and I take a cue from Raymond Spider as we get into some leadership lessons. How do you stay focused on your end game when everyone else thinks you just might be wrong? Subscribe to Brazen Plus on Apple Podcasts. The Closer is a production of Project Brazen in partnership with PRX. Our show is produced by Isabel Kirby-McGowan and Ben Walsh. Mariangel Gonzalez is our project manager, Olivia Mead is our researcher, and Lucy Woods is head of research. Golda Arthur is our showrunner, and Bradley Hope and Tom Wright are executive producers. Megan Dean is programming manager, and Ryan Ho is design lead. Our marketing consultant is Maggie Taylor, and Noor Abdel Latif is our podcast strategist. I'm Amy Keene. Thanks for listening.